This information is designed to provide accurate and authoritative information with regard to the subject matter covered. It is offered with the understanding that the presenters are not engaged in rendering legal, accounting, or other professional services. If legal advice or other expert advice is required, the services of a competent professional should be sought.
Well, good morning and welcome everyone. This is James Orr and you're in for a treat today. We're going to be going over the Nomad 101, the basics of the Nomad investing strategy. I am James Orr, real estate broker here in Fort Collins, Colorado, and going to go over exactly what Nomad is and who it's for and a example of how it kind of works out for a lot of those different folks. So let's jump right into the presentation. So first, let's talk about what Nomad is. Nomad is, in the most simplest way I can describe it, is you buy a home as an owner-occupant, and owner-occupant means you're planning on moving into the property. You're getting special owner-occupant financing. You live there for a year, and the living there for a year is a requirement of the lender. If you're buying a property as an owner-occupant, the lender is going to require that you live there for a year, as of right now, what the current rules are. So you stay there for a year, and then after you've lived there for a year, you buy a new home, and you convert the previous home to a rental, and then you repeat the process until you have as many rentals as you want. Usually the hard limit is going to be 10 because you can usually only have 10 loans in your name that are owner-occupant before they will not give you any more loans. So basically that is going to be your hard limitation, but the model we're going to run through is if you had bought a home every year for 10 years, and we're going to talk about that a lot in detail. So that's the basic idea of what Nomad is. Now there are some significant variations to the base model. We teach this in some advanced classes for the Northern Colorado Real Estate Investor Group. But we're only going to go over the basics today. That's why it's called Nomad 101. And tonight is going to be a single house example. So we're not going to be switching up the house on you. We're going to stick with one property. It's currently for sale in our local marketplace. And so you could buy this property if you were watching this video close enough to when I recorded it. Now, I don't know if it's going to be available. This type of property is going to be available in 6 months from now or whatever it is, but you can get the idea of what the property is from tonight's example. I will tell you that having looked at a bunch of properties, I've been a real estate broker since 1998, and having looked at a bunch of properties, this is an exceptional example. So this is not like an average or middle of the road type example. This is us cherry picking a great property to do Nomad with. In fact, I would call this a 1 out of 50 or 1 out of 100 type of deal. You're not going to see these every day, and that you would need to be very selective about finding a deal this good. So let's jump right into what we've got going for tonight. All right, so one of the things we've been covering for the Northern Colorado Real Estate Investor Group is on each presentation we've been talking about what our primary, secondary, and then light focus and no focus is for each meeting, or for each for the whole year, I should say. So the primary focus for the upcoming 2016 year, we're going to be talking about residential buy and hold properties, buying properties that are single-family homes, duplexes, triplexes, and fourplexes, and then also 5+, which are a slightly different loan program. They're usually commercial financing, but a 6-plex or an 8-plex or an 11-plex or 17-plex. We're also going to focus on Nomad, which is what this class is all about. We'll be focusing on selling with lease options. When you own a property, actually finding a tenant buyer who's going to rent the property from you for a year or 2 years, and then they're going to buy it from you for a pre-agreed upon price. We'll also be focusing on real estate partnerships, partnering with people. Let's say you have down payment, but you don't have the time or the ability to go find great deals. Partnering up with someone who can find the great deals or who can manage it or put together a lease option. Or maybe you can sign for a loan, but you want to use your down payment for your own deals, but you have the ability to sign for more than one loan, and someone else has already maxed out on their loans or unable to qualify for some reason. You can partner with them, and we're going to structure partnerships and talk about how those work through our classes this year. One thing I want to point out is that for our primary focus, there's no one item that's greater than another. So Nomad is not more important than selling with lease options in our kind of class schedule. They all kind of have equal weight. Our secondary focus for this upcoming year, wholesaling outside the MLS. Finding a property, putting it under contract, in some cases closing on it and selling it to an investor, in other cases assigning your contract and selling it to an investor. And we're focused on doing that outside the MLS. I don't think there's a real opportunity to do this inside the MLS in our current marketplace. So we're in the hottest real estate market I've ever seen. From a data standpoint, we are at the lowest inventory level we've ever seen since I started tracking data, going all the way back to 1997. So basically, you can see that it's going to be really hard to wholesale inside the MLS. Can be done, but we're not going to focus on it at all. Secondary focus, buying subject to or with lease options, is usually going to be off-market stuff, but we will cover some of that. Buying, fixing up properties, refinancing, and holding. I think we're going to have a little bit of focus on that, although those deals will be harder to do. And then a very light focus, we'll have a couple classes and some data on the fix and flip model, buying a property, fixing it up, and reselling it. And there's a couple slides in tonight's presentation about that as well and how it relates to Nomad. Just as important as what we are focusing on is what we are not focusing on in 2016. And so 3 things that we will not focus on at all: wholesaling inside the MLS, we're not going to really discuss it at all. Selling with a real estate agent, in my opinion, in this market, you should be selling with using a lease option as your exit. Of course, if you have to sell something very quickly, you should use a real estate agent, but we're not going to be teaching that. And then non-residential real estate investing. We're not talking about industrial buildings or renting retail space or things of that nature. We're really focused on the areas I just went over. So let's talk about why Nomad. So in one of the things we're doing this year for the NCREG classes is we are actually talking about why invest in real estate with one slide, and then overcoming fear with another slide. And the overcoming fear is on the next slide, but why real estate in general, and why specifically Nomad? And so one of the things I want to point out to you is the Federal Reserve Survey of Consumer Finances actually does a survey every 3 years. They did it in 1998 all the way through 2013. They're probably due to do one this year in 2016. I'm interested to see the data. And last night when I gave this presentation live, Brian had mentioned that he heard when he was doing research for another presentation that the average net worth of a renter actually went down from the numbers I'm about to show you. The number I'm going to show you is that it was just about $5,000 is the average net worth of a renter, and Brian seemed to see data that suggested it was down to $1,000 now. So I'll just kind of read some of the bullet points on here and talk about them. In the past 15 years, the net worth of the typical homeowner has ranged between 31 and 46 times that of the net worth of the typical renter. So not $31,000 more, not $46,000 more, but 31 times to 46 times the net worth of a renter. And the chart on the right is showing you this same data, by the way. The homeowner equity is a substantial component of homeowner wealth. The Federal Reserve's Survey of Consumer Finances, conducted once every 3 years, provides a snapshot of family income and net worth along with basic demographic details and more detailed information on where families keep the wealth they have accumulated. The most recent survey, conducted in 2013, offers a picture of the situation as home and equity prices normalize for most household balance sheets. Data shows that median, this is the important stuff, data shows that median homeowners had nearly $200,000 in net worth, or 36 times that of the median renter, who had just over $5,000. The median value of owners' homes was $170,000. So it's fascinating to me that the difference between someone who's renting and the difference of someone who's a homeowner is 36 times. It's 36 times better to be a homeowner. Now, I'm not sure if it's cause and effect. I'm not sure if you, because you become a homeowner, you have a net worth of 36 times, or if it just happens to be really tightly correlated, but that's a pretty significant difference. Continuing on with reading here, many households own a primary residence, 65.2%. It is the most common held non-financial asset after vehicles, and vehicles, 86.3% own vehicles. So I thought that was pretty interesting stats, and that's from the Economist from the Realtor.org website, and the address for that is right on there. So all that information is from them. So the next slide we usually talk about is a slide on overcoming fear, and kind of the idea we've talked about in the past is we've had slides on gaining market knowledge is one way to overcome fear. Practice and going through things and having a system and a process is another way to overcome fear. We've talked about some tools from Tony Robbins as to how to change your state and overcome fear. But the one I want to talk about tonight is this idea of someone who has successfully done things before, or who is an expert in the field of investment. And so Warren Buffett, who is from time to time the richest person in the world. Right now, I don't think he's the richest. I think he's like 2 or 3. But this is a guy that knows about money management, knows about investing, and understands probably a lot more than the majority of people out there about the investing models and what's important to investing. So he has actually said some very interesting things about owning single-family homes, which is what Nomad is about. So Warren Buffett goes on to say, along with equity, single-family homes are a very attractive investment right now. Well, that's pretty interesting. The second richest guy or third richest guy in the world saying single-family homes are a really attractive investment. My ears kind of perk up. Appearing live on CNBC's Squawk Box, Buffett tells Becky Quick he'd buy up a couple 100,000 single-family homes if it were practical to do so. A couple 100,000 single-family homes, huh? That's pretty interesting. If held for a long period of time and purchased at low rates, which rates are actually near all-time lows, it actually went down last week. So we are... despite the Fed raising rates, interest rates have actually gone down. But Buffett goes on to say, if held for a long period of time and purchased at low rates, Buffett says, houses are even better than stocks. He's a big stock guy. So for him to say houses are even better than stocks, that's very interesting. He advises buyers should take out 30-year mortgages and refinance if rates go down. Wow. So basically he's telling you, go buy single-family homes and get a 30-year mortgage on it, and if rates go down, go ahead and refinance the house. And that if he could, he'd go buy a couple 100,000 single-family homes. So when we're talking about Nomad tonight, or this morning, basically we're saying go buy owner-occupant homes, live there for a year so they can get the owner-occupant financing, get a lower down payment, and then convert those to rentals so that you have 10. If you could do a couple 100,000 like Buffett wants to do, great. But I think 10's a much more reasonable number, and I think you'll be impressed by what the returns are on them. Let's take a look. All right, so one of the things I want to do with each one of our presentations is kind of show you where you are in the whole process. If you're working with a real estate agent to buy real estate, then kind of understanding where you are in the big scheme of things is kind of important to me. So this is the whole process, big picture process of buying a house. You have your first meeting with me if you're working with me as a real estate broker. Then we do a couple things before we go look at houses. That's the pre-showing step. Then we do the things like showing houses, where we actually go out and look at properties that you're interested in. Once you find that you really like and you want to move into, we would actually go write the offer on the property, and that's the writing offer step. And once you get an offer accepted, you go from contract to close. That's when you're under contract to buy the house, but before you've actually closed on it. Then we have the closing, where you actually take ownership of the house. And then after that are all the things that happen after the closing, which things I do for you after you own real estate, like classes and help you with understanding the value and working through challenges you have with your property. So that's kind of the overview. And tonight we're going to be talking about the first meeting. That's why it's highlighted green. And specifically, here is the first meeting with me kind of process. So in other classes, previous classes we've done, we've gone over the definition of working relationships, the exclusive right to buy listing contract, which allows me to represent you in the transaction and still be paid by the seller so that my services are actually free. So that's the exclusive right to buy listing contract. And then we also covered professional services provided, which that covers what I do versus what an attorney does and what an appraiser does and what the inspector does. It kind of lists out the services and who handles what things in the transaction. So we covered those in previous classes. Today we're going to be talking about your real estate goals. And we're going to look at how Nomad can get you to what your goals are. And I'll show you some examples and some charts and data. This is a really engineer-friendly process, especially the charts and stuff, because the engineers really get into the charts and seeing me model the finances and the money side of it. So that's what we covered today. That's why it's highlighted green. And then normally what else we'd cover during the first meeting with me is financing. And you can access that in Financing 101. It's a video we did and I recorded. It's available online on the website. Receiving property lists, which I've also recorded and made available online. That's about how to search for properties and what you should look for when you're doing that before we go look at properties. And then analyzing deals. Brian's taught 2 classes on that so far, and I'm in the process of putting up additional recordings of those classes as well. And then writing offers. We're going to cover that in a future class, probably I think 3 weeks from now. So that's basically the first meeting. We're going to talk about your real estate goals and specifically Nomad to achieve your real estate goals today. So who is Nomad for? Nomad's not for everybody. If you are not willing to move and you don't have kids and they're not willing to move, or grandkids and they're not willing to move, Nomad's probably not for you, because with Nomad you have to get an owner-occupant loan. That's the definition of what Nomad is. You're moving from house to house. If you want to just invest in real estate, you put 20% down or 25% down, depending on which loan you're on, and actually buy investment property. You don't have to move into them to do it, and that's a good model. Nomad, as we'll kind of compare later on, is a little bit better as far as return on investment goes. You can get there with less money out of pocket. So who is Nomad for? Number one, in my opinion, this is the biggest group. It's people that are behind on what they need for retirement. They wake up one morning and realize, oh my gosh, I am not where I need to be in order to plan for my retirement. I'm not going to be able to live on the $200,000 I have saved, and I need to really ramp it up and get in gear. And Nomad can definitely help get you there. The second group is people who have limited down payment and want to get started investing in real estate. There's lots of folks that they've read a book or they've seen a webcast or read a website or saw a late night infomercial or watched a video about how real estate is great and they'd like to get involved, but they don't have a lot of down payment in order to go out there and buy 10 rental properties with 20% down or 25% down. And so the Nomad model allows you to get involved with, on the first property, you could do it with nothing down, but in most cases 5% down. The third group is young professionals looking to build massive wealth. If you just graduated college, you've got a great job, and you're thinking to yourself, okay, I don't want to be at this job forever, or maybe you do want to be at this job forever, but you want to have a really good retirement. The young professional and the Nomad model go great together. You're an engineer or a software programmer or something like that, and you're working at a tech company, and you're willing to move each year into a new house and kind of convert the other ones to rentals. This is a great way for you to keep your job, build massive wealth with the real estate, and we'll show you exactly what massive wealth means with numbers, but it's a great model for young professionals. The fourth group is people interested in passing on wealth to their kids or grandkids, and this is something that my wife and I are doing, and I'll talk a lot about that today in our presentation. But if you're concerned about your estate size or making sure your kids are well taken care of, this is a great model for doing that. And fifth, the people wanting to pay for college for their kids or grandkids. And I won't talk a lot about this model, but using the money that you generate from the other four groups, and you'll see how it works, you'll be able to more than pay for college for your kids and grandkids. And today I'm primarily going to be telling you stories about these properties, these kind of situations. So I'll start off talking about the young professional, and we'll go through and we'll kind of build on this story. I'm going to use the same properties and the same acquisition plan for everybody, but I'll be telling you different stories so you can kind of see some of the subtlety and nuance for all of them. So this model kind of came about. We started the Nomad model. A good friend of mine and I were talking over lunch one day about trying to do Robert Allen's model. And Robert Allen's model is you buy 20 houses over a 10-year period. So you buy 2 houses a year, and then at the end of 10 years, you actually sell off half of the houses, and then you have 10 houses free and clear with no mortgages on them, and you can live off the passive income. That's his model in his book, Creating Wealth. And just as an aside, I personally believe most of the other parts of the book you probably shouldn't bother reading, but this is worth reading. Going and reading his model of what this his kind of buy 20 houses, two per year, and then selling off half at the end and kind of selling and paying them off. It's a really interesting read. Also, Brian pointed out last night that we did a full presentation on this probably a year ago now, maybe a little bit more, and the slide deck is available on ncraig.com/files. And we worked out the model here in our local market to see what it looked like. I've also done a full day presentation on this kind of model probably 10 years ago now. So with his model, basically the end result is after 10 years, you have 10 free and clear properties that you're getting good positive cash flow on because they don't have mortgages on them, and you're able to rent them out and live off those. Now there's some assumptions for his particular model. First of all, you need to be buying properties with little or nothing down, which in our market is kind of hard to do. You can definitely buy the first one with no money down. You need to buy a USDA property, or if you have VA benefits, you can get a VA loan. So you can do that. But after that, it's really hard to do the nothing down properties in our current market. And also in his model, the appreciation must be really high. And the last couple of years, we've definitely seen that appreciation rate be high. And kind of all of the economic studies of our local marketplace suggest that we will see a doubling of our real estate values in the next 10 years. So that's a 7.2% appreciation rate each year in order to achieve that, which may or may not do that, but I think we're going to see a really strong appreciation. Historically, our numbers have been closer to 3 or 4, closer to 3 in Loveland, closer to 4 in Fort Collins. But you can kind of get a feel for what kind of appreciation you'd need in order to do his model for creating wealth. So his model's got a couple challenging things to do with our local market. So when we were talking about this, my friend and I were talking over lunch about his model, and he was thinking about doing some variation of creating wealth and how it might work. We were talking back and forth, and we were talking about one way to kind of keep your down payment low is to put owner occupy the properties and move in and do for an FHA 3.5% for the first one, and then you can do conventional. Conventional allows you to do 3% down, as low as 3% down right now in our current marketplace, and 5% down I think is a little bit more conservative in what I use for Nomad. But we started talking about that, and I started running some math in my head, and I was like, that model is going to work out really, really well. The returns are going to be phenomenal, and we started just working through some math in my head, and I told him I'm going to go build a model and spreadsheet this, and kind of just analyze it. And so I went home that afternoon, and I built a really crude spreadsheet, and eventually it turned into my analysis that I'm going to show you all the slides from, where we can run this analysis on any property in the MLS, and the numbers look phenomenal. I mean, they're like amazing. So let's go take a look at what the numbers are, but it's based off really loosely Robert Allen's creating wealth model, except we're not going to be paying off the houses unless you're in catch-up mode, and I'll talk about that when we get there. All right, so let's talk about why doing Nomad. And I've kind of hinted at this earlier in this presentation, but let's just go through it right now. So what are the pros of doing Nomad? Pros are you're owner-occupied, so you get lower down payments. If you were going to go do a just straight investment property, you'd probably need to put 20% down for the first 4, and probably 25% down for loans 5 and on. And so with the owner-occupant one, you can do very low down. In most cases, 5% for most of the properties, and there's some exceptions where you can get lower than that in the first one. And in some cases, by the way, you might still want to put more than the minimum down. The more you put down, the better your cash flow is going to be. Another advantage of doing owner-occupied for Nomad is you get better interest rates. An interest rate for an investor loan is probably in the ballpark of about a 0.5 percentage point higher. So if you can get 4% as an owner-occupant interest rate, you may be able to get 4.5 for an investor rate. So your interest rates are going to be better, which are going to help with cash flow. And that's a pretty significant difference at the low end. A 0.5 point, going from 10 to 10.5 is not a huge change. But, going from 4 to 4.5, that's a pretty significant increase. It's 12% more. So basically, another reason to do Nomad is that you can actually educate yourself and learn over time. So you can take your time and learn about the model. You buy a house, you move in. You don't need to know about finding tenants or screening tenants or managing rental property or understanding all the nuance and detail of Nomad. You can go and buy a property after listening to this presentation. Just have in mind that you're going to keep it as a rental, and then we can educate you over the next year through the NCRED classes and make sure that you understand what's going on, and you can learn about stuff over time. So you don't have to know everything from the very beginning, which you do in a lot of other models. The other thing is you're leveraged. Instead of having to put 20% down, you can put 5% down and do Nomad. So when you put 20% down, you're leveraged 5 to 1. You put down 1/5 of the price of the property, and so you have a 5 to 1 leverage. If you're putting down 5% of the property as a down payment, then you're 20 to 1 leverage. So you're more leveraged when you do Nomad. So what are the downsides of doing Nomad? Well, one of the downsides is because you have to move into the property and stay there for a year and live there, you can only acquire 1 property per year. Now, if you've got kids, which I do, and you're going to have them do Nomad, you could do 1 per year for each child. So your children, once they're ready to start moving into houses, can actually buy a house and move into that house, and you can pass on your wealth to them through that. And the downside is you have to live in the property for a year. If you put 20% down or 25% down, you buy it as an investment, you don't have to move in. But if you're doing Nomad and you're moving into the property, getting owner-occupant financing, you have to live there for a year. And that is a lender requirement. So it's a restriction from the loan. And if you kind of try to break that rule, you're committing loan fraud, and you might be able to have free room and board and wear orange all day. So I don't recommend that you commit loan fraud. You have to live in the property for a year, and don't try to sneak your way around it and say, I'm gonna tell them I'm gonna live in the property, but really I'm not gonna live there at all. I heard this too many times. You don't need to cheat on the system. Just go ahead and suck it up and move into the property and do Nomad. If you're not willing to do that, you should put 20% down. All right, so before we get into kind of return on investment, so I'm going to be talking about where the return comes from when we talk about Nomad. I want to give you a quick overview of the 4 different areas where we get a return when we invest in real estate. And return on investment is abbreviated as ROI. So in this slide, you can see a little visual image showing you the 4 areas where we get a return when we buy investment real estate, and then ROI in the middle showing you that this is what kind of makes up the return on investment. So the first one is appreciation, the tendency for property values to go up over time. You buy a property, 20 years ago, and 20 years later it's worth more. That is appreciation at work. Property values tend to go up over time, and I think it's largely due to inflation personally, but we could argue that. The next return you're getting is cash flow. Cash flow is the money that is thrown off usually from the difference between the rent you're collecting and the payments you need to make on the mortgage, the taxes, the insurance, your maintenance on the property, any management that you're doing. Anything that's left over is positive cash flow. If you happen to have your expenses are more than what you're collecting in rent, you have negative cash flow, and so you'd have a negative return on investment from that. The next area of return is debt pay down. Every time your tenant makes a payment to you and you make a payment to the mortgage company, you're paying down on that loan. And so you're actually getting a return on your money from paying down the debt. That's what debt pay down return is all about. And then you get tax benefits. I'm going to talk about tax benefits here in a minute, but basically the government gives you the ability to depreciate the value of your real estate. They think that over time your property is being depreciated. It's actually going down in value because you need to replace things and things like that. And so they give you a tax break in order to help offset that. I can go through the math here, and I will in a moment, but basically the idea is that tax benefits can help offset income you're getting from elsewhere, and it'll improve your cash flow. And so you do get a return from your tax benefits when you buy investment real estate. So we just talked about the 4 areas of return. Which 2 of the 4 are market dependent? Appreciation and cash flow are dependent on the market. If the market goes up, your appreciation is great. If the market goes down, your appreciation is negative. So what happens in the marketplace affects what your return from appreciation is. Similarly with cash flow, if rents go up, your cash flow typically improves. If rents go down, your cash flow typically gets worse. And so depending on what's going on in the marketplace, you can improve or have worse appreciation and cash flow. And you have little control over that. You have some control over appreciation. You have some control over cash flow, partially in your selection of the property and property characteristics, and a little bit about what you do with the property. But overall, the market forces are really strong, and you don't have a lot of control over those. Which 2 of the returns, though, are market independent? Basically, no matter what happens with the market could go up, the market could go down, your return that you're getting from paying off the debt on your loan, as long as you make that mortgage payment, which is completely within your control, if you can make the mortgage payment, you are getting the debt pay down return. And with Nomad, if you're putting 5% down, I think the debt pay down return is about 11%. So you're getting a better return. We're going to talk about what the stock market return is here in a little bit. And I've assumed a pretty conservative 10% per year return in the stock market, which I think is a little bit aggressive. It's conservative in that we're trying to handicap Nomad and give the stock market the benefit of the doubt and say, if you can get 10% in the stock market, you're doing great, and here's what the numbers look like. But if you just look at the debt paydown return, a return that's not market dependent, you're getting a better return from paying down debt on your investment than you would in the stock market. And that's really interesting to know. It basically means it doesn't really matter what happens to appreciation and cash flow. Your debt paydown return by itself will be worth doing the Nomad model. And then tax benefits, also not market dependent. As long as the federal government continues to have the same tax law in place, which some people would argue that's questionable, but as far as we know, there's no change on the horizon for a depreciation tax benefit, and as long as they don't change that, you get it. And we'll talk about what that benefit actually looks like. But it doesn't matter if the market's going up or down or what's happening with cash flow, your tax benefits are there. And so those are market independent. So tonight or this afternoon or whatever it is right now, this morning, I don't even know what time it is. Yeah, it's this morning. So basically right now we're going to go over what the Nomad model is, and these are the assumptions I used for the property. So as I told you, I'm using one single property, and we are going to use that one throughout the entire presentation. All the slides and everything are based on the assumptions right here in the property. So I'm going to go over these a little bit in detail so that you know what we're going to use. This is a property that's currently for sale in our MLS, and we're assuming the initial purchase price is $276,456. So about $276,500. Okay, that's what we're assuming you're purchasing the property for, and that includes adding in seller concessions so that you can get some closing costs rolled in. You don't have to come out of pocket for this. That way we don't have to deal with closing costs and the down payment. We're just going to deal with the down payment because you're going to roll the closing costs into the loan. And on this particular property, you could do that. The rent we're assuming for this property, the property I'll tell you is in Windsor. It is the initial rent for that property is $1,750 per month. I'll tell you it's a 3-bedroom, 3-bath, 3-car garage property, brand new. Nice property. Very nice. So to think you can get $1,750 for rent on a $275,000 property in Windsor seems pretty reasonable to me. If you want to go run your own numbers and rank comps and see that, you're welcome to do so. Some people last night when I gave the presentation live thought that was actually a little low. So I want to be conservative. We're assuming $1,750 a month in rent for that. We are assuming that the house values, as you buy more of them and as they appreciate and as you own them, are going up 3% a year. In Fort Collins, it's closer to 4% over a very long period of time. The last 3 or 4 years, I think last year was like almost 13%. The year before that was almost 10%. The year before that was almost 8%. So the values of houses going up 3% is conservative. And I'm making it conservative because if I put in 7 or 8%, which I don't think is realistic, the numbers look crazy amazing, like unbelievably amazing in the sense that it is not believable. It could happen. I mean, we've seen it the last 3 years. I see 7, 8, 9, 10, 11, 12, 13%. But if we use 3%, it's a much more conservative, much more believable, much more doable, achievable type of model. And so we're using 3% for home appreciation. We're also assuming that rent is going up about 3% per year as well. Rents have tended to keep in line with what home values are. Over a very long period of time, I've looked at charts over, I think it's like 40 or 50 years, and you look at the value of houses and the value of rents, and they are almost linear, step in step, with going up in value together. Sometimes, they lag a little bit, but they catch up. Okay, so 3% per year appreciation for house and 3% per year appreciation for rent. I'm also assuming you're putting 5% down for all the properties. You could do a little less for the first property. You could put down more to improve your cash flow. I'm also assuming you're getting a 4% interest rate. And that also includes PMI. So instead of actually paying PMI monthly, we are actually taking a slightly higher interest rate, getting a credit back from the lender, and then we're doing using the lender credit to pay a one-time upfront PMI payment. So that's a 4% interest rate. Your yearly HOA. So this particular property has an HOA. It's about $540 per year. We're also assuming that the HOA is going up at 3% per year. So we're taking into account inflation on the HOA rates. The maintenance reserve, we're setting aside a certain amount of money from the rent each month to cover maintenance, carpets, repairs on the property, things of that nature, and we're setting aside 12% per year into a reserve account and doing that. So that is not included in the positive cash flow. So basically, you'll have a maintenance reserve and the positive cash flow on the property is another way of me saying that. And so we're taking 12% of the rent each month and setting it aside. We're also assuming that you are managing the property yourself, so there's no property management fee. And then I have some other assumptions here when I do a class on the kind of paying for college using Nomad. I have some other assumptions in there, but since we're not talking about that at all tonight or right now, basically I will ignore those. Stock market return, 10%. Is what we're saying the stock market is able to get each year. I personally think that the stock market can't quite return 10% consistently over a 40-year period of time, but we're using that to give the stock market an advantage. So when we compare Nomad to the stock market, I want to make Nomad really conservative, and I want to make the stock market look really, really good to show you that they're not even close, even when we give the stock market an advantage and we give the Nomad model a disadvantage. And then income tax rate, when we're calculating what the benefit is from depreciation, you need to know your income tax in order to see what amount of money you'd get back. And so we're using about 29% for an income tax rate. So those are the assumptions for the Nomad model. So let's talk about the story. So first I'm going to tell you about the young professional Nomad. And in my mind, I'm visualizing somebody who recently graduated from college. Maybe he's a year out, 2 years out. He's got a great job. Maybe he's an engineer at Avago or HP or Agilent or AMD, or maybe he's at Woodward or something like that. But he's got a great job and a little bit of money saved up to buy a home. Maybe he got a signing bonus and he got, I don't know, $15K or $5K or whatever. And he's been saving up a little bit of money. He went from being a poor college student to making whatever an engineer makes, and he's been able to save up $15,000 or so to buy his first house. You could do this with less, but we're not going to be talking about it here. Furthermore, the young professional has been moving each year in college. Over the last 4 years in college or 5 years in college, they've been actually moving every year into a different apartment, and so they don't have a lot of stuff. Moving's not that inconvenient or a hassle, and if it makes sense to do so, they would continue moving. They wouldn't go and buy $50,000 worth of furniture that they would need to move. They're going to go take their time, keep their belongings light, kind of live an essentialist lifestyle for the next 10 years. They'll kind of, as Dave Ramsey would say, they will live like no one else so that later on they can live like no one else, or whatever his saying is, the idea of kind of living frugally for a low period of time so that you don't have to do that later on. So we're going to talk about the young professional here. So the young professional has some options. Number one, they could do the Nomad model. We're going to go into a lot of detail. Or they could take the same amount of money that they were going to use for Nomad, and they could actually invest that in the stock market. So if you took the same money and invested in the stock market and you got a 10% return, and by the way, when I talk about the same amount of money, I'm talking about the same money they would use for down payments, and if they have negative cash flow, which I'll talk about a little bit here in a bit, if they had negative cash flow, taking that money too and investing in the stock market. So it's not just down payments. If they have negative cash flow, we're also going to say they'd have to put that in the stock market too. Now, we are ignoring the tax benefits. So we're going to handicap Nomad a little bit and not talk about the benefits you'd get from depreciation or the tax benefits. We're going to ignore those. If you want to see why I use the 10% average return for stocks, I put a little reference page up there as to where I got that number from. I didn't just pull it out of my butt. I actually went and did a little research, and I think that is a conservatively high. It is aggressively high for the stock market, but conservatively high for Nomad. So using those numbers, we're talking about the young nomad, the young professional nomad actually taking 10 down payments over 10 years and investing those in the stock market. They would have invested about $161,500 over 11 years in the stock market. And why 11 years? Because in the 11th year, you have a small negative cash flow they had to make up for. But after year 11, there's no negative cash flow. So 161,000.5. And after that time, if they basically invested that money over 11 years and they kept it in the stock market, did nothing else, in year 40, when they're about ready to retire, let's assume they're 25, and so by the time they're 65, when they're ready to retire, they would have approximately $4.8 million in year 40. Realize, those are $4.8 million in money 40 years from now. It is not today's dollars. So some people would argue that with inflation and stuff like that, that's really worth about, $1 million, $1.5 million, something like that in today's dollars. So if they went and they put in $161,000 over the next 11 years, they would have $4.8 million in their stock market account in year 40, which in today's dollars might be worth 1.2. If we kind of use a really, really conservative rule of thumb that says about 25% value in today's dollars to kind of break it back here over 40 years, that seems pretty reasonable to me. So do you think investing $161,000 over 11 years to get $4.8 million in year 40 is worthwhile? I think it is. But let's do this. Let's take a look at what the investment looked like over time, and then we'll compare it to Nomad and see if you still think it's worth doing it that way. So here's how it looks like if they invested that money in stock market or houses. So what's going on in this chart is it shows you each year, so each column is a year, and it shows you the blue section shows you the amount they would need for a down payment, and the little tiny red sliver, year 2 through 11, is the amount of negative cash flow they would have in that year. And this is summing up. The negative cash flow is for all the houses they own. Okay, so there's not much negative cash flow. When you do this model with a house that's not like amazingly good, and this one is amazingly good, when you do it with a house that's not amazingly good, your negative cash flow is usually much bigger. Okay, so if you read the Nomad book, you'll notice a similar chart in there where the negative cash flow is a much larger percentage of the kind of amount you need yearly. And one of the reasons why this particular house is so good is because it has very little negative cash flow. Okay. So in year 1, they would need about $13,823 in order to do their first deal, and that's usually the down payment. In the second year, they need $14,237 and a little bit of money to cover for the negative cash flow. I'm going to break it out and show you. Okay, so you can see what the progress is over 11 years. And if you were doing the stock market, you would take that same dollar amount, but instead of using it for a down payment, you'd buy stocks. And in year 2, instead of taking the down payment and the negative cash flow, you'd actually take that money and buy stocks. Okay, so that's they're either investing in Nomad and doing down payments, or they're doing stock market. This is the same chart as before, except I'm not showing any of the negative cash flow. I'm only showing the down payments. That's the only thing I'm doing here. This next slide, I'm not same chart from before, except I'm not showing any of the down payments. I'm only showing the negative cash flow. Before, because it was so small, you couldn't see the dollar amounts. It wasn't zoomed in enough. And so now you can see that in year 2, the negative cash flow for the entire year is $271, or about $25 a month. That's how much you need to cover the negative cash flow. And as you'll see in a second, you really don't even have negative cash flow, because you're going to get tax benefits that'll more than cover for that. Okay. In the worst year, in year 11, you need $354 to cover your negative cash flow on all your properties. Okay, and that's assuming all of your expenses, including 12% for maintenance, taxes, insurance, and HOA that's been increasing, your mortgage payments. So all of that stuff is all included in our math. Okay. So let's take a look. Basically, in our worst year, we would need $354 to cover the negative cash flow. But as I'm about to show you, you really don't even have negative cash flow. So I took this slide from another presentation I did where I talked about break-even cash flow is really positive cash flow because of depreciation. So you get tax benefits of investing in real estate. You get two ones. Number one is depreciation, which we're going to talk about. And number two is your interest deduction. And we're going to assume that just offsets the majority of the rent you're getting. So you get to write off the interest you're paying on your loan, but really that's just offsetting the rent you're getting. And so I'm not going to go into detail on that. Talk to your CPA for more detail, and I've oversimplified it, okay? But let's talk about depreciation, which is also an oversimplification, but let's go into detail and see how it might work in one specific situation. So cash flow from depreciation. So we're going to make some assumptions, and I'm going to work through some math for you. We're going to say the value of the property, not including the land, just the actual building itself. The calculation for depreciation from the federal government is you take the value of the property and you divide by 27 and a half years. That's the period of time over which you can depreciate the property itself. Land does not depreciate. Land doesn't go down in value like that. It doesn't wear out. But property does. Okay? So you can actually wear down the property, depreciate it over 27 and a half years. And so this property is about $276,000. And actually, it's not in Fort Collins, but it's close enough. It doesn't really matter. So $276,000 divided by 27 and a half years. Actually, we need to subtract that the land first, so I got ahead of myself. So $276,000 minus $60,000 for the value of the land means that the property value, the actual house itself, is worth $216,000. $216,000 divided by 27 and a half years equals $7,854 in depreciation benefit. So to oversimplify, you get to deduct the $7,854 from the income you earned. So if you earned $100,000 per year, you can say, I now earned $92,150 and only pay taxes on the $92,000 because with depreciation you can offset that income. Okay? So if you were in the 25% federal tax bracket and the 4.63 Colorado state tax bracket, you would actually get $2,327 more back in cash on your taxes because of that depreciation. Or you could pay in that much less. It's another way of looking at it. Okay? So each month you could have $194 per month from the depreciation benefit. Now remember, the negative cash flow on the previous slide was $271 for the entire year. The max was $354. And from the depreciation on one house, you're making about $200 a month, $194 a month. So it more than pays for, in fact, the depreciation in year one almost pays for the negative cash flow for the entire 10 years. Another way of looking at it. So really, you don't have negative cash flow with this. And in cases where, sometimes we talk about the Nomad with other properties. And in the previous Nomad book, the negative cash flow was much more significant. The depreciation benefit, a $200, $194 per month depreciation benefit per house, more than covers for the negative cash flow on almost all these properties. In fact, we could run the math and see. Okay, so let's talk about the amount invested per year. So down payments, just to kind of recap, we started out at about $14,000 per year in year one, and to buy the 10th home, it was about $18,000. Okay. Now we have some other strategies we'll teach in more advanced classes on how to work with down payments, using strategies like lease options or things like that. But right now we're not going to cover that. But realize that you need about $14,000 in year 1 to buy the first house and about $18,000 in year 10, and then in between it grows over time. Okay. Negative cash flow starts out to be just under $271 in year 2, the first year you're renting, and peaks out at about $354 negative in year 11. Now remember, cash flow without tax benefits is positive from year 12 on. And cash flow with tax benefits, when you include depreciation, is positive from basically the first year you're renting. You can eliminate negative cash flow completely by putting a larger down payment. Really what we're doing is we're putting 5% down in the property. If you had put 20% down, you'd have positive cash flow from day one. You wouldn't have to deal with negative cash flow at all, not even including tax benefits, which would still help out. Okay? So really what you're doing, since you didn't put that full 20% down, you could think of the negative cash flow, the $271 that you're paying in year 2, as financing the down payment you didn't have when you bought. So instead of having to put another 5% down, you can say, I'll pay $271 per year instead of putting another $14,000 down in the first year. Okay? That's the kind of solution. Now, we also have some strategies we can use to mitigate negative cash flow. We'll teach those in future classes. I don't want to get into that much detail tonight or right now. Okay, next slide shows you the sum of all the amounts invested. So this is the same kind of numbers I was talking about, but instead of showing you each year how much you put in, it's adding it up. So you can see that basically we start off, we need a little bit, and over time each year the amount we needed total has grown until finally we peak out at that $161,000, and it shows that we're not adding any more money from about a year 11 on through year 40. We're not adding any more money to our initial investment. So this is a total amount that you invested. We're making the investment over that first 11 years, the majority of it over the first 10, because those are all the down payments, and then a really small negative cash flow in year 11. All right, let's talk about the returns you get from the stock market over 40 years. So the next slide is going to show you the overall return from the stock market had you invested your money as we described. And again, we're talking about the chunks from down payments and the negative cash flow, and you getting a 10% return. So your total investment in the stock market, I know this sounds like I'm repeating myself, I want to make sure we understand it. Your investment of about $161,500 over it's over 11 years, would have grown to be worth $4.8 million in year 40. And that's what this slide shows. Basically, it shows you how much money you invested starting in year 1, and that your balance of the whole thing in year 40 is up here at $4.8 million. This is what it grew at over time. Returns from Nomad. Okay, this is the same assumptions I gave you before. We're using $270,000 as the purchase price. We're adding in some seller concessions, 5% down, 4% interest rate, $1,750 for rent, 3% rent appreciation, 97% occupancy. So we're taking into account that the property is vacant 3% at a time, 12% maintenance reserves, 0.6% for taxes, 0.5% of the value of the house for insurance, and $540 per year HOA with a 3% HOA appreciation rate. Those are our assumptions for this. Your investment of about $161,500 over 11 years would have grown to be, this is where I pause for dramatic effect, $13.7 million in year 40. That's $8.9 million better than stocks. And to kind of be fair, because before I kind of reduced the stock market number down to kind of say what it is, because this is inflated dollars, it's in year 40. In today's dollars, if we assume it's about 25% of what it's going to be worth back, then I did the same thing with the stock market. I went from 4.8 down to about 1.2ish. So this is about 14 million. So it'll be worth about 3.5 million, 3.4 million. A lot better than 1.2 in the stock markets in today's dollars compared to the Nomad model is going to be about 3.4. So considerably better. This is the chart that shows that. The blue line is your stock market balance. It's the chart I showed you 2 slides ago. And you can see that grew to be about 4.8. And then the Nomad one shows you that the red line has grown to be in the same time period about 13.9. So the Nomad model crushes it. This is a really simplified version of the same chart. Just shows you the total amount return from the stock market versus Nomad. Nomad is in green, 13.7. Stock market's in blue, 4.8 in year 40. Pretty impressive. All right, so return on investment for stocks. I just want to give you some idea of how I did the calculation. So I definitely deal a lot with engineers. They're kind of numbers people, and they want to know how I did my calculation. So this is for engineer people. For stocks, I add back in all the returns we've gotten and then compound on that to determine my return. Okay. For houses, I'm only really accounting appreciation and debt pay down and cash flow, but I'm not adding the positive cash flow back in. Because one could argue you got cash flow thrown off from the property. You could use that money in order to pay down debt or to buy another house and kind of compound the cash flow portion of it. For the houses, I'm not doing it, which is conservative. You'd want me to do that if you were kind of trying to compare stocks to houses because we want to handicap Nomad to make sure that it performs better than expected. Okay, so in this case, I'm not adding back in positive cash flow from the houses. I'm counting it on the first time it's made, and I'm counting appreciation. I'm counting debt pay down. I am not also counting the tax benefits. So remember that extra $2,000 per year that you got in cash flow per house? I'm not counting that. So the numbers are even better. But let's go and show what the return on investment would be for stocks and what the return on investment would be for houses. So for stocks, starts off in year 1 at 10% return on investment. That's the return we're getting. But as you add more money in, it compounds. In year 40, it ends up being a 271.29% return on investment per year. Houses start out at just over 93% return on investment in year 1, and they work up to be just shy of 439% per year in year 40. Why is the return on investment so high with Nomad? Partially because you're controlling a $270,000 asset with only $15,000 down. It's highly leveraged. The stock market's not leveraged. Stock market, you're putting the money in and it's just compounding. With the Nomad model, you're putting a very small down payment, and the reason we're doing owner-occupant is so we can do as little as 5% down, and then you're able to have that grow. You're able to have the house value grow at a really conservative 3% per year, and you're getting the benefit of leverage. So let's take a look at the chart. So this chart shows you the actual return on investment number, the percentage return on investment for the stock market versus Nomad, ignoring depreciation over time. One thing that I want to point out about this is at some point these cross over. The stock market return actually gets better than Nomad. Does anyone know why? It's because we are no longer leveraged after we paid the houses off. So once you've held the first house for 30 years, that mortgage is gone. You're no longer leveraged. It's basically an unleveraged asset. And the unleveraged asset return is actually less than the stock market return. Okay? So you can see that, for the first 40 years, Nomad crushes it. But at some point, the lines cross over. The stock market will become better return than Nomad unless you re-leverage or you do some additional investing with the money you have from Nomad. Interesting note about putting 20% down. If you had put 20% down instead of the 5% we're talking about to do Nomad, the stock market overtakes the Nomad's return in about year 25. So much sooner. If you're putting less money down, the stock market return actually does better than Nomad. So another reason to do Nomad versus doing just 20% investing. Before those years, though, Nomad is better even with 20% down. So for the first 25 years, Nomad crushes it even with putting 20% down. 20% down would require about 4 times, a little bit more than that actually, the down payment over the first 10 years. Or instead of $160,000, you need about $640,000. And actually, that's not even right. It's because you need 20% down for the first 4 properties, and then after the 5th property and on, you need 25% down to buy investment properties. So it's even more than $640,000. It's probably closer to $800,000, if not more than that. So the Nomad model allows you to invest less. 160 versus 640 on the low end. And if you put 20% down, you'd also have positive cash flow from the very beginning, which we've discussed. And with this particular house and depreciation, you really do have positive cash flow from the beginning when you take into account that. All right, this is a great slide. So I had a client relatively recently email me and ask me, how much money do I need to do this Nomad model? And I had been meaning to make this slide for a while, but I basically sat down and I decided I was going to make the slide right now. And so I sat down and I worked with a lender and I used the 45% debt to income ratio that they require and using 75% of the rents. And I figured out how much you would need in order to do Nomad, assuming you're buying a new property every year. And the numbers we've been using tonight, basically all the same. And so in order to do it, in year one, assuming you have no other debt. If you have more debt, you need money in addition to this in order to cover the debt. But this is the gross income you would need to do in order to qualify for buying the house with the other properties that you own in later years in order to do it. So in year one, you would need about $4,349 per month household, not per spouse. So if it's you and your spouse that are actually going to do Nomad, between the both of you, you would need to make about $4,400 per month. Gross, not take home. Okay? In year two, you need about, I'm going to round up, $4,900 per month. In year three, you need about $5,277 per month. In year four, $5,650 per month. By the time you get to year 10, actually, I think it peaks out before year 10. Yeah, it looks like it's $6,438 is the high in year 8. But after year 8, that's the highest you need to do. So $6,500 a month approximately, assuming no other debt, in order to do that for your entire household. So each spouse would need to make about $3,250, or $3,250 times 12. That's about $37,000 a year, if you get a feel for what you need in order to do the Nomad model. Okay. All right, so that's the young professional nomad. Let's talk about the catch-up for retirement nomad. And so here's this person. This person is, 40 years old. They're not quite where they need to be for retirement. They wake up one morning, they see an article in the paper about, planning for retirement, and they're like, oh my gosh, I'm 40 years old. I haven't been quite saving for retirement like I should have been. I got maybe $161,000 in my retirement account, or saved up in my retirement in regular accounts. So what is the fastest way to get caught up for retirement and get where you need to be? So the same assumptions for the stock market in Nomad. You invest about $161,500 over the first 11 years. But you can't wait the full 40-year period that the young professional was waiting for. Remember, we modeled it. We said, okay, the young professional nomad's about 25, and he's got a 40-year time horizon before he's ready to retire. So he's got 40 years to grow Nomad. The catch-up for retirement Nomad does not have that time. They're 40 years old now. They may have 25 years if they want to retire at 65. So let's take a look at a chart showing how the stock market compares using the same assumptions we've been doing the whole time. But let's just show years 20 through 30 so that you can look at your time horizon. If you're a catch-up nomad, you can kind of look at your time horizon and see where you need to be, or what your results might be doing Nomad, doing that. So here's the chart. And it basically shows in year 21, basically if you start at year 40, you'd be 61 years old then. You have about, I don't know what that is for the stock market, maybe 800,000 or something like that. These charts are all interactive on my website, but when they're on PowerPoint, they don't become interactive anymore. So basically, you'd have 3.3 million if you did Catch-Up Nomad. I'm sorry, yeah, Catch-Up Nomad. You'd have about, 800,000 or so if you did just stock market. And you got 10% return, which I think is pretty aggressive. In year 25, you probably have about a full $1 million. And you have about $4.8 million if you did Nomad. So Nomad is considerably better if you're trying to do catch-up Nomad. Instead of taking that $161,000 and trying to get a 10% return in the stock market, you'd be much better using that money and buying Nomad properties. You'd actually be 4 times better, according to this chart. Okay. In year 30, if you were willing to wait until you started at age 40 and you were willing to go to 70, basically you'd have $1.8 million in the stock market and $7.1 million in Nomad. So Nomad's considerably better there. So positive cash flow. So Tammy thinks this slide, my wife Tammy thinks this slide's a little bit confusing. So let's kind of just not talk about it for a minute. Let's not read through it. Let's just have a discussion. So let's kind of fast forward. You're a catch-up nomad. You've kind of invested in the stock market, and you're getting ready for retirement. You've got $1 million in the stock market. What do you need to do in order to start seeing that return? You need to start pulling your capital out and spending it. And as you pull capital out, there's less there to grow. So you're really dipping into what's growing as your asset. Now, that's not the same as Nomad. Nomad, you have 10 houses that are free and clear. Maybe not free and clear by the time you're, if you're doing catch-up Nomad, but, they're close to free and clear. And you're not having to, sell your house or refinance your house. You're able to see positive cash flow being thrown off from the rental property without touching the asset, without touching the investment itself that's growing in value. So the difference between stock market and the Nomad is the stock market, you usually have to start dipping into the asset itself in order to get enough money to live on. With Nomad, you can actually live off of the passive income generated from the rentals and continue to let your rentals either pay off if you've got loans on them yet, or just go up in value from appreciation. And rents tend to increase over time because they're indexed for inflation as well. So you've got multiple things working for you versus doing the stock market. Now, one of the things I also want to point out about this is, let's say you got $1 million in the stock market, or you've got $4 million from Catch Up Nomad, and you need to get access to a bunch of money very quickly. Let's say you, for some reason, didn't have health insurance, and you ended up having a heart attack, and the surgery and all the different fees and everything for doing the heart surgery is $800,000. That's a devastating event if you're in the stock market, because you basically need to liquidate 80% of your stock market holdings and bring yourself back down to a $200,000 stock market balance, which you're not going to be able to live off of in order to pay for that heart surgery. With Catch Up Nomad, though, you actually have solutions. You could refinance a free and clear property, or 2 or 3, in order to get the equity you need in order to pay for the heart surgery. You could sell off 1 or 2 or 3 houses, whatever you needed to do in order to pay for that, and then you'd still have 7 properties left in order to kind of continue on with Nomad. So with Nomad, you could borrow against or sell houses that you need to if you need an influx of cash. With the stock market, you got to sell stock. I guess you could borrow against some of the stock market stuff, but the return you're getting on the stock market is usually not enough to support that. Some cases it is, but most of the time, especially if you're getting closer to retirement, you're probably going to go to a more conservative, less aggressive stock market return and kind of portfolio. So how much positive cash flow can you get from the Nomad model? Because it's throwing off this cash flow. So let's take a look at years 20 through 30 so that you can pick out your time horizon for doing Catch Up Nomad. So these are the net, after all expenses, cash flows of all your properties combined doing the Catch Up Nomad model in year 20 through 30. So, if you started at age 40, the year 21 is age 60 for you. And at age 60, Catch Up Nomad will be throwing off $79,000. Now realize, that's 20 years from now. So just like we talked about earlier, we got to discount that into today's dollars. And maybe 20 years from now, it's about half. In year 40, we were saying it's about a quarter. So in year 20, it's probably going to be about half. So you'd be generating about $40,000 per year in today's dollars. Okay. In year $20, it's actually $79,000. Okay. In year 25, you'd be generating, I'm going to squint really hard and call that about $120,000. And maybe that's worth, a little bit less than half. So maybe $50,000. Okay, so that has now grown to be about $50,000 in today's dollars. If you were making $50,000 per year passive, after all expenses on your income, on your properties, not including depreciation, by the way, which would increase that pretty significantly. Although at year 25, you're starting to come up on when you lose appreciation because it's only good for the first 27 and a half years. So the first property, you only got 2 years left of depreciation. Then you don't get that benefit anymore. But basically, in year 25, you're making about $50,000 net per year. Okay, in year 30, $165,000. So probably in the neighborhood of $60,000 ish. Okay, so compare that to what you might see in the stock market, and I think you'll find that Nomad's much better. Shorter time frame. So can you work the model? But let's say you want to do Nomad, but you don't quite have that full time period, and you want to kind of compact things to make it as profitable as you can from a cash flow perspective and do that. And so one of the things I'm modeling is the ability to sell off some of your properties to make sure that you own free and clear properties to improve your cash flow. And the model that I'm about to show you, it's not finished. It's actually much more complicated than I anticipated solving this kind of model problem, but I have a really rough version of this that I want to share with you, and I'm going to walk you through it. Okay, so let's just pretend for a minute you're doing Catch Up Nomad. You bought 10 properties over the first 10 years, and let's say you started doing this in year, you were 55 years old. So you're 55 years old and you just started doing Nomad. You acquire 10 properties over 10 years. And then year 11, you're like, okay, I need to consolidate. I need to maximize the cash flow I'm getting from these properties. What can I do? And so what you're going to do here is you're actually going to sell off some of your properties, use the proceeds from those sales in order to pay off properties that you own. Okay? So in this model, basically the houses are number 1 through 10 on there. It shows you how much equity you have in each one of the houses. And then on the right-hand side, the 3 columns are kind of summary columns. I'm going to go over those in a second. Okay? So in year 11, you have one property. Your first property you bought, you have $172,000 in equity in that property at this point in year 11. So you're actually going to take that property. You're going to sell that one. You're going to sell house number 2 with $158,000 in equity, and you're going to use the equity in those from the sales. You're going to use the proceeds from those sales, and you're going to pay off house number 3. So house number 3 becomes free and clear. You don't have any mortgages on it, and you're maximizing the cash flow from it. Okay. Then you're actually going to sell off house number 4 and house number 5, and you're going to pay off the loan on house number 6. Okay. So now you've sold off 4, and you own 2 properties free and clear. Okay. You have house number 7, number 8, number 9, and number 10, and they still have mortgages on them. Okay. So to kind of go to the right now to the summary, you own 2 free and clear properties, and you've kept a total of 6. The 2 free and clear and the 4 ones with mortgages. And the income, the cash flow from those 6 properties is going to equal $40,000 per year. Okay. So basically what we just said is this. You could take $161,000 over the next 10 years, use it to invest in Nomad, sell off 4 of your properties in order to have 2 free and clear and 4 properties that still have mortgages on them, and convert that to a $40,000 per year passive income stream that's going to go up over time. Okay, that's what we just did. So in year 11, after doing Nomad for the first 10 years, you've converted $160,000 to basically $40,000 per year in income, and you still have a ton of equity in properties. You still have probably, let's see, what is that? That's probably $250,000 in equity in the properties, and that's going to grow each year. I'm sorry, I take that back. You have $250,000 in equity on the properties you still have mortgages in, and 2 free and clear properties, which are probably worth $300,000 each. So you've actually gone and created, about $850,000 in equity in your properties. Okay, so you can kind of see how that works. In year 20, I'll just kind of go through it in year 20 again, just to kind of walk you through. So going down to the very bottom, the bottom line on this particular table, you have one property. The first property you own has $361,000 in equity. You're going to sell that one off, pay off the small mortgages on number 2 and number 3. You're going to sell off property number 4. You're going to pay off mortgages on number 5 and number 6. You're going to sell off number 7. You're going to pay off the mortgage on number 8. You're going to sell off number 9, and you're going to pay off the mortgage on number 10. By doing that, you end up having 6 properties, and all 6 of them are free and clear. They don't have any mortgages on them. And using that model, you now have $150,920 per year in passive income. Now realize that's in year $20. So it's probably closer to about $75,000 per year in passive income in today's dollars. Okay? Let's go and take a look at the next set of years. So this is years 21 through 30. One of the things I want to point out is year 25. So in year 25, your first property has $494,000 in equity. You're going to use that, you're going to sell that and pay off the mortgage on number 2, number 3, number 4, number 5. You're going to sell off property number 6, and you're going to pay off number 7, number 8. You're going to sell off number 9, and you're going to pay off mortgage number 10. That means you'll have 7 free and clear properties, and you'll generate about $200,000 in passive cash flow, which, probably 90,000-ish, in today's dollars. So not a bad start. That same investment in the stock market in year 25 would have been worth $1.1 million. So if you had taken your $161,000 and put it in the stock market, you would have had $1.1 million in the stock market. Now you have 7 free and clear properties worth probably, $500,000 each. So basically you have 7 times 500, about $3.5 million, and about $204,000 in passive income, about $90,000 in today's dollars. Okay? The 1.1 million is probably worth, I don't know, $500,000 in today's dollars, to kind of give you an idea. The other interesting thing is if you had not paid off these properties, if you had not actually sold some and paid some off to make them free and clear, in year 25, your cash flow, if you had just kind of run the normal Nomad model, would be about $120,000 per year. So you've increased cash flow by about $80,000 per year by selling off some properties and consolidating. Okay? So if you need to catch up, kind of look at this table and figure out where you need to be, and then you can work the math backwards. All right, let's talk about story number 3. Passing on wealth to kids. So this is actually me. So this is me and my wife, actually. So you have kids that just get out of college, although my kids aren't quite out of college. I've got one as a sophomore in college right now and one who is a senior in high school who may not go to college. So he may actually start the Nomad model earlier. But, the idea is your kids just get out of college. You're starting to think about estate planning and leaving a legacy. You're trying to kind of set your kids up to succeed in life. So how can you transfer your wealth to your kids? And, financial advisors will go and they'll discuss this with you. And I think you should get a financial advisor involved. And I'll show that next slide here. But really, you should get a comprehensive plan. But in my opinion, this is a good part of your plan. And your financial advisor may not understand this particular part of your plan because they don't specialize in the Nomad model in real estate. And, they specialize in stocks and insurance products and things like that. And I think you should do some of those as well. Here's a great quote from Warren Buffett. At least I think it's a great quote. Basically, it's a very rich person should leave his kids enough to do anything, but not enough to do nothing. So I want to set my kids up so that they can do whatever they want in life. And I'm not going to give them enough money that they can just kind of like do nothing in life, but I want to set them up so that over time they'll have more than enough. But they need to do something productive and contribute to society. Okay, so that's kind of my philosophy moving forward and how I'm thinking about this when I'm talking about doing it for my kids. So again, talk to your financial advisor. This should just be one small piece of your overall financial plan, but you really need to talk to a professional that does this as a more holistic and comprehensive approach. So here's what we're going to do. I'm going to gift my kids a down payment and possibly some of the negative cash flow each year and have them do Nomad. So each year, the annual gift exclusion, the government allows you to gift a certain amount to your kids, or to anybody actually, per year. And so the annual gift exclusion is $14,000 per year, per child, per parent. So for example, James Jr., my son, I can gift him $14,000 in a year, and my wife can gift him $14,000 in a year. So he can receive from us, both parents, $28,000 total per year. My other son, Timmy, I can gift him $14,000 per year. My wife can gift him $14,000 a year. So that's $28,000 total per year for him. And there's a reference on here about the IRS gift limits and kind of what they are. So you can go read about those. So this allows us to transfer money outside of our estate early and avoid having to pay taxes on it. Basically, we're doing this tax-free. We basically give it to our kids tax-free, and they actually invest in Nomad, and then eventually, when they grow their assets, eventually they'll have to pay taxes on the proceeds from selling the properties unless they do a 1031 exchange or they do some tax planning on their own. Okay. So remember, to do Nomad, we estimate we'll need to do the following. We'll need to have about $13,823 in year one. So we don't even need to do the full $28,000 for each child. We can just gift them $14,000. One parent can gift them $14,000, or each parent can gift them $7,000. It doesn't really matter. About the most they'll need is in year 10. They'll need about $19,000, well below the $28,000 limit. Now, what happens if, for some reason, they happen to live in a different city or something like that, and they need more than $28,000 to do Nomad? Could I give them more than $28,000? Sure, I could give more than $28,000. My tax, the only benefit is that the only difference is I'd have to pay tax, or they'd have to pay taxes on the amount over $28,000. The first $28,000, $14,000 for me, $14,000 for my wife, is actually tax-free. And actually, their grandparents could gift them $14,000 more tax-free as well. But once you get over $14,000 for a person, you need to pay taxes on that. Okay? So really, we're well below the limit doing stuff in Fort Collins. But if you happen to be in a city that needs more, or negative cash flow is significant, or they need repairs on the property, or something like that, you could gift them more. Okay? So why Nomad for your kids? For me personally, I talk about personally why I would do this, and of course, if you have questions you want to discuss it with me, go ahead and give me a call. But for me personally, I'll be taking a small part of my estate and getting it out of my estate early for the following reasons. Number one, my kids with Nomad can grow the money at a much higher return on investment than I can. Let's talk about the next chart. So this is the return on investment comparison between my kids doing Nomad versus me taking that same amount of money, and instead of me buying a property, which I'm not going to buy 5% down because I'm not going to live in it, I buy an investment property. I put 20% down. So the red line shows my return on investment with a 20% down payment buying rentals versus my kids actually going out there getting 5% down, doing Nomad, and getting the return. Their return is much, much better than mine. Okay? So in order to get a higher return, it's better for me to get it out of my state and allow my kids to compound it more quickly. Why Nomad with your kids continued? So another reason, I can give small down payments and some negative cash flow now and over the next 11 years without paying taxes. So we actually end up saving on taxes. We're optimizing our kind of tax planning strategy. With Nomad, my kids can grow their money very aggressively. We just talked about that. And it allows me to slowly educate and grow fiscal responsibility in my kids over time. This is actually really important to me. If I don't give my kids money now and teach them how to manage rental properties and teach them how to manage money and become better financial, fiscally responsible, better stewards of money, if I don't do that now, when I die, let's say, I die 20 years from now and, I give each kid 10 free and clear rental properties. They're now, 40 years old, 45 years old, and they're inheriting 10 rental properties, and they're overwhelmed. They've never managed rental properties before. They don't have any clue how to manage the asset. They have no idea how they work. They don't appreciate it. They don't understand. They just think of it as this big piggy bank, and they kind of let it go to waste, and they don't do a good job. I would much rather have them say, okay, listen, I'm going to gift you the down payment for your first house. You're going to move in, but the requirement for you to do so is you need to start coming to these classes we teach on how to manage rental properties and the Nomad model. And you'll spend one evening a week doing this and understanding how to manage your own assets. And if you do that, I'll gift you the down payment for the next house. So you'll have another rental property. Okay? And so we kind of encourage them, reinforce the behavior by doing that. And we educate them so that by the time they're ready to go into their first property, they know a lot more than they did on day one. And they get one tenant to practice on. And then at the end of that first year, they're going to get another rental property, and they're going to have 2 tenants to practice on. And they're going to slowly grow in responsibility and learn how to manage the property. And they'll have lived in each property for a year, and so they'll know the property well, and they'll know what maintenance looks like and what they need to do, and they'll start to understand that. And so it gives them the ability to learn over a very long period of time, 10 years, and get guidance from me and from other people we might bring in to speak on Nomad. And I get to bond with my kids. I get to kind of continue to share and educate them about finances, and we have lots of different talks, and they get to hear what I tell other people, because sometimes me telling someone else something, the child is more open to understanding and appreciates that lesson more than if you tell them directly. Because sometimes they don't necessarily want to hear you. So continuing on. So when you're ready to retire, they'll have taken the $161,500 that was gifted to them over 11 years, and that would have grown to be $13.7 million in year 40. So basically, you're going to gift your kids $13.7 million by having them do Nomad for the first 10 years. They're going to move into properties, and you're going to help educate them. These are the numbers from this first story, the same numbers, except the difference is we've gifted the down payment money to our kids over time. Okay. I'm just going to show you this next chart, which breaks out the difference in equity and cash flow. So here, this chart basically shows you how much is coming from cash flow. It's like $4 million and change, and then how much is coming from equity. It's about $8.5 million for the total of whatever it was, 13 point something, for the total amount of equity and cash flow for each child. So you can take $161,000 out of your estate over 11 years, gift it to your kids, and then they can actually have $13 million in assets, each one of them, when they're ready to retire. This also gives them the power to help fund your grandkids, their kids' college. They have a bunch of assets. By the time, if they get out of college and they start at age 25, by year 20, they're like 40. Their kids are starting to think about college. They've got, $3 million in house equity. Can they use the cash flow they're getting from the houses they have in order to pay for, college tuition, or tap into the equity if they need to pay for it all up front. Sure. So it really sets you up in order to help your kids pay for their kids' college. And they could use some of the cash flow that's being thrown off from the rental properties to pay for their own college. So maybe you didn't do as much planning as you should have for paying for college for your kids, or maybe you don't believe you should pay for your college for kids. Either way, now your kids can use the cash flow from some of the rental properties in order to help offset their debt pay down on their student loans. All right, so continuing with why you should Nomad for your kids. So this provides a big asset base and then monthly cash flow for your kids. And the asset and cash flow grows over time as they mature and become better stewards of money. So by the time your kids are ready to retire, without doing any additional saving or investing beyond the Nomad you gifted them, and I would encourage them to do their own as well, do some stocks, do some additional real estate stuff, but their asset base, just from the gifts we're giving our kids and the gifts you may decide to give yours, their asset base of 10 free and clear houses will be growing at about $261,000 per year. That's using a 3% appreciation rate. They'll have a yearly cash flow after expenses of about $454,000 per year. Now realize that's 40 years from now. So again, if we're using a conservative number and kind of rolling it back, that's about $120,000, $110,000 per year in passive income in today's dollars. Okay? And then this is all outside of your estate, so you have no estate taxes on it. It allows your kids to do Nomad for their kids and easily pay for your grandkids' college educations. Right? They can then continue the gift. So this changes really the structure of your family tree. Your financial family tree, you do this for your kids, and then your kids have the capacity to go do it for their kids. I'm going to show you 3 charts that break out appreciation, debt pay down, cash flow by year, but I'm not going to go into a lot of detail. I'm just showing them to you. If you're welcome to pause the video and kind of look at them if you want some information about them. So this shows you the chart of the appreciation gain per year per child. So each kid is growing, in year 10, they're growing by about $95,000 per year from appreciation on all their properties. That's a pretty significant growth rate. So that's like them almost saving $95,000 per year in the bank. They have to be making a decent amount of money in order to be saving $95K. Okay. The next one shows you the debt pay down. This is how much they're paying down on the debt they have on the property. So in year 10, they're paying down about $63,000 per year on the debts they have on the 10 properties that you Nomaded with them. So that's like another forced savings plan. By paying down debt, they're building up $63,000 in more equity because the tenant is paying the rent, which they're using to pay down this debt. In year 30, they're paying about $135,000 a year down on their debt. And then this is the cash flow. So it starts off really, really low. You have a little bit of negative cash flow, which we talked about earlier. By the time they're year 10, it looks like it's about, I don't know what that is, $15,000 a year. By the time they're at year 20, it looks like it's about, I don't know, $80,000-ish per year. And then by the time they start selling off houses in paying off houses in year 30, it looks like it's starting about $155,000 per year, $155,000 per year. Okay? And then this next chart is all 3 of those things just combined right on top of each other. So you can kind of see how they interact. One thing I will point out to you is the first 10 years you're acquiring new properties each year. That's why some of the curves are a little different there. Years 10 through 30, you're not selling any properties, you're not acquiring any properties, so the curves should be relatively straight and linear at those points. And then from year 30 on, some of your properties are being paid off. So the first property gets paid off in year 30, the second property gets paid off in year 31, and so on. And so the curves change over time for those. But you can see them all. So why Nomad your grandkids? You could also Nomad for your grandkids. So let's say your kids, you've maxed them out, you've gotten them 10 properties, and now they've got kids of their own. You can actually gift your grandkids Nomad money and do the same thing. As soon as they get out of college or whenever they're done with they're starting their life, you can say, okay, listen, I'm going to give you enough money for down payment on your first house. I want you to take these classes on the Nomad model so you can become a better steward of money and learn how to manage property. And provided you do that, I'll give you the down payment for the next one, and I'll help you buy 10 rental properties and build a big asset base that'll give you passive income so that you can do whatever you want, and you just can't do nothing. You need to go get a job and have the loans to be able to get these properties. So basically, I'll help you with that, but you need to kind of meet me halfway. And so you can do that with grandkids as well. And then finally, kind of wrap up the presentation, real estate investors that have very little to put down. So the more down payment you have, the more likely you are to have positive cash flow. We talk about this 5% down and having a little bit of negative cash flow because this property is exceptional. But in most properties, if you don't put the full 20% down, you're probably not going to get positive cash flow in our marketplace. So you're going to have a little bit more negative cash flow, and you'll have to kind of budget for that. And it'll be made up for by depreciation in most cases. Run the math, make sure before you buy it. But if you want to, you can solve this problem. You can actually put more down payment down. So basically, if you have very little down payment to start with, or you want to leverage your down payment over more properties, you can do that. You can use a VA loan in order to get your first house with nothing down. There's some exceptions where you can get your second house using a VA loan with nothing down. And then if you want to do one house with a USDA loan, it's a property a property outside the city limits in more rural areas. You can go ahead and do that. But VA, you need to have VA benefits. So you need to have been a military member, or your spouse needs to have been, or some other way to get the VA benefits. I'm not sure if there's other exceptions to that. You can also do down payment assistance to minimize down payment. So we can get an FHA loan and get down payment assistance from the county or the city or whatever it is. And in some of those cases, it's as low as 1% down. So those are the low down payment models. But in most cases, you're going to need probably 3 to 5% to do Nomad at a minimum. And you could probably do the first couple using these strategies, a combination of USDA and FHA with down payment assistance, or VA if you've got them. But after some point, you'll probably need to put 3%, and probably 5% is what my preference is for you. So a lot of things real estate investors talk to me about, and this is kind of that fix and flip slide. So real estate investors come to me and they say, I want to get started. I want to kind of build up a little nest egg in order to kind of get started in real estate investing. And the way that I'm going to do that is I'm going to go fix and flip properties. I'm going to go buy a property, fix it up, and resell it. And I'm going to make a $30,000 profit, and I'm going to use that to then kind of roll into some rentals and stuff like that. I think that's a mistake. I think really the better model is to go and do one house as a Nomad, and then save up a little bit of money over that next year, and then do your second Nomad and do your third Nomad. And I have some strategies we could talk about, advanced strategies for kind of building up down payments. But fix and flips are like work; they're jobs. I mean, you got to go find the property, and especially in this market where inventory is really low and the market's so hot, it's very hard to find fix and flips. You got to go, oversee the maintenance on the property, the fix-up part of the property, and hire contractors if you're not going to do it yourself. And then you got to sell it, and you got costs, of money, you got there's lots of things. It's a very expensive model, and so I wanted to show people what the difference between the fix and flip model is and buying rental property. So I did some math, and buying one rental property like the one we've been modeling throughout this entire presentation and holding it for a 30-year period. So you buy a rental property, maybe you do it as a Nomad, maybe you don't, but actually the model is based on you doing it as Nomad. So you buy a property as a Nomad, you hold it for 30 years. That's the equivalent, holding that one rental property for 30 years is the equivalent of you doing 37 fix and flips, making $30,000 net profit each. The amount of money, I'll say it another way, the amount of money you make holding a rental property for 30 years is the same amount of money you would make doing 37 $30,000 fix and flips. So doing Nomad with 10 properties over 40 years is the equivalent of doing over 400 fix and flips with $30,000 profit each over the next 40 years with a small fraction of the same work. Very, very small work. So you could either do 400 fix and flips over the next 40 years, or you can just buy 10 Nomad properties over the next 10 years, move 10 times, move 11 times. You got to move out of the last one, and be ready to go. Okay? So I want to show you a chart that I did, and some people are confused by this chart. Don't worry about it if you don't understand it, but I'm going to show you what it is. This chart shows you how many fix and flips you would need to do in that year in order to make the same amount of money as doing one rental property. So for example, if you look at year 10, you need to do 0.81 fix and flips per year in order to make the same money as doing one rental property and holding it for 10 years. Okay. In year 20, you need to do 1.02, or about one fix and flip a year, in order to make the same money you would as a rental property. Okay. So that chart just shows you how many you would need to do in order to, how many fix and flips you need to do with $30,000 profit net in order to do the same number as the rental property. Okay. And that is the end of the presentation. I hope you enjoyed that. I definitely did. I really like the Nomad model. I think it's a great model for a lot of folks. I think there's a huge group of people out there that need to catch up for retirement, and this is a perfect way for them to catch up. Then I think there's a lot of young professionals out there that they see it. They know that our market's going to double in the next 10 years, and they're looking for a way to take advantage of that, and this is a great way to do it. Start buying one property, move in, live there for a year, come to all of our classes, get an education on how to manage them, buy your next property, continue to come to our classes, get the education, and I think it's a great strategy for them. You'll do phenomenally well. So if you've got questions or if I can help you acquire properties here in Northern Colorado, I'm a real estate broker, and my services are free. Basically, when you go buy a property, the seller pays me my fee, and whether you have a brand new agent, which is not me, who hasn't done any transactions, doesn't know the contract, doesn't know how to negotiate, doesn't understand the Nomad model, or you get my services, someone who's been licensed since 1998, focuses on working with investors. 80% of my clients are investors, and knows and has documented and creates tools and resources and does 50 plus classes a year on educating people on how to do Nomad. Whether you use either one of those, the cost to you is the same, because when you go buy a house, the fee is paid by the seller in 99.9% of the time. There's a couple exceptions with for sale by owners, but we can definitely talk about those. But the overwhelming majority of the time, it doesn't matter if you've got a brand new agent or you're working with me. The cost is the same, so you might as well work with me and have you help you do the Nomad model and create tools and resources and continue to educate you throughout the process. So definitely come, contact me if you're interested in having me work with you as a real estate broker. I'm happy to help. There's my email address, which is probably my preferred way to communicate, but I'm happy to do phone. You could text me to that same number as well. That's my mobile phone number. You can go on my website as well for some additional tools as well. So hopefully I'll hear from you. This has been James Orr. Have a great day, and I will talk to you soon. Bye-bye for now.